what is stochastic oscillator. And by the end of this session, you should be able to understand what is stochastic oscillator, how to interpret and use the indicator. The stochastic oscillator is a popular trading indicator used to determine the strength of a market's momentum. When the stochastic oscillator is above 80, the market is overbought. And when the stochastic oscillator is below 20, the market is oversold. The stochastic oscillator compares the current movement to its recent range, highs and lows. Let's look at the formula based on 14 days. Percentage K equals to the latest close price minus lowest price over the last 14 days divided by highest price over the last 14 days minus lowest price over the last 14 days and times by 100. And the percentage D is 3-day simple moving average of percentage K. The percentage K basically looks at where the market is right now in relation to its range over the past 14 days. Meanwhile, percentage D smooths out percentage K, making percentage K less choppy and sensitive to the market's daily price changes. Let's look how does this illustrate the market momentum. When market trends higher, the market will be at the upper end of its 14-day range. Hence, percentage K will go up and percentage D will follow percentage K higher. And when the market trends lower, the market will be at the lower ends of its 14 days range. Hence, the percentage K will go down and percentage D will follow percentage K lower. This indicator has fixed range between the 0 and 100 and the stochastic cannot exceed 100 level and cannot fall below 0 level. Traders usually add extra 2 more levels to indicate when the market reaches the overbought and oversold level. The extra 2 levels can be customized according to traders' preferences, but in general, level 80 usually will be overbought and level 20 will be oversold. We'll go through the stochastic indicator trading technique in details on chart and also how to use it with combination of price action. Let's begin with placing the stochastic oscillator on chart. To place the stochastic oscillator on chart, there's few methods to do it. The first method is go to Insert, then Indicators. Under the oscillator, select the stochastic oscillator. The second method will be the easiest one as you click and drop it from the navigator panel. To do that, simply go to Navigator panel, Indicators. Under the oscillator, click the stochastic oscillator, drag and drop it on chart. It's done. Now let's look how to use the stochastic oscillator in trading. There are 4 methods in which traders can use the stochastic indicator during trading. They are identifying the extremes in stochastic by going long when the market is oversold and going short when the market is overbought. Second, identifying the divergence between the stochastic indicator and the market. Third, trade when percentage K and percentage D cross over after being overbought or oversold. And finally, on the fourth, using the stochastic in combination with a trend indicator. Let's look one by one in details how to use them. Overbought or oversold. The most common stochastic trading strategy is to look for overbought and oversold extremes. This means that traders buy when the stochastic oscillator percentage K falls below the 20 oversold and sell when the stochastic oscillator percentage K rises above 80 overbought. The logic behind this strategy is that when the market rallies too much, it's more likely to make a pullback. On the other hand, if the market falls too much, it's more likely to make a bounce. This method can be used only when the market is in sideways, but not during trending. Just because the market has rallied too much and is overbought, it doesn't mean that the market must drop. And when the market has fallen too much and is oversold, It doesn't mean that the market must rise. There is no such thing as the market has rallied or fallen too much, or it must reverse. Let's look at this example. Market continuing to rally despite this stochastic oscillator, suggesting that the market is overbought. Bullish or bearish divergence. Mostly, traders use divergence to predict tops and bottoms in the market. A bearish divergence happens when the market making higher highs. But the stochastic indicator does not make higher highs. This indicates that the market is overextended. The rising power is minimal and signals the market may fall soon. Bullish divergence. A bullish divergence happens when the market making lower lows, but the stochastic indicator does not make lower lows. This indicates that the market is oversold. The decline may be slowing down and signals the market may rise soon. Here are few examples of divergence signals. Crossover. Traders can also use this stochastic crossover by following the direction of the major trend. For crossover method, traders will look for extreme stochastic readings and then execute a trade after a pullback. This means that the trader should buy when the stochastic indicator %K is oversold below 20 and %K crosses above %D. In other words, going long when the market is oversold, but is starting to reverse upwards by crossing back the level 20. And for sell, when the stochastic indicator %K is in overbought above 80 and %K crosses below %D. In other words, going short when the market is in overbought but is starting to reverse downwards by crossing back the level 80. Here are few examples of crossover signals. And finally, the combination. The final method is to use this indicator in combination with other indicators that define the market's trend. So how do we define the market's trend? There are many ways, but one of the easiest and most common ways is to simply look at the market 200-day moving average. This means that traders should go long when the market is above 200 moving average and made a short-term pullback and the stochastic is below 20. And traders should go short when the market is below the 200 moving average and has made a short-term bounce and the stochastic is above 80. Here are few examples of combination signals.